My name is Kathy Davey, and I will be talking today about Ashburton's international equity side of the business with my colleague, Dr. James Cook. So let's start off. What we're going to cover today is diversifying offshore, and then we'll just chat around our active equity approach. So first of all, I just want to start off with this chart, which really shows the analyzed return versus the analyzed risk of the FTSE All World Index against the FTSE JSE All Share Index over the past 5 years. And as you can see, if you had kept your money globally, you would have achieved a higher return with a lower level of risk measured by volatility. And really what this is saying is it's always a good idea to diversify your assets offshore, your equity assets offshore. And this is really so that you can gain access to economies that may be growing faster than your local economy, but also gain access to sectors that you might not be able to access within your local market. So just looking at comparing the different sectors of the JSE All Share compared to the All World Index. As you can see, the JSE All Share is very weighted towards basic materials, which of course also means very weighted towards Chinese demand. Then when you move across and we look at the technology bars, you can see that even though both the All World Index and the JSE All Share have a similar amount allocated towards technology within the indices, we know that for the JSE that's mainly made up of one company, Naspers, which also of course is very reliant on China. And then for the FTSE All World Index, we know there are a lot of different tech companies. We're looking at the FANGs, then of course we have a lot of smaller companies, we have hardware, we have software, we have services. There's just so much more to choose from, and we know this is a very exciting sector at the moment, and we just get a whole lot more choice when you go global. I think lastly, what I'm going to chat around for this particular chart is healthcare. As you can see for the JSE All Share Index, really you don't get a lot of exposure in terms of healthcare. You get a lot more on the All World Index. And this is a very important sector, not only because it gives some nice stability to a portfolio because it's quite a defensive sector, but also because we really are an aging population. We're living longer. People are becoming more health conscious. We self-medicating more. It's a great sector to be able to get good access to, and you get that access better by going globally. So what I'm going to do now is I'd just like to chat around a couple of trends and sectors that we like at the moment. First of all, I'm just going to talk around the semiconductor chip market. Now, I think really what's interesting about this market is that most of the companies that play within the semiconductor chip market are in the US and Europe and Asia. But what's interesting about the chart you'll see in front of you is that a lot of the actual manufacturing of semiconductor chips for third parties happens in Asia. So even though you might have independent device manufacturers such as Intel in the US that do manufacturing themselves, they still rely for a certain amount of capacity on third-party foundries to develop their chips, and also obviously all the fabless companies are also going to be, of course, depending on those manufacturers within Asia to develop the chips. So the globe has basically a very high reliance on Asia in terms of developing and manufacturing these chips. So why do we like this sector? I mean, I think what you've seen recently is we've seen a lot of shortages in the semiconductor chip industry, and basically there's a lot of reasons for this, but it comes down to demand and supply. There's just not enough supply for the current demand, and really the reason being is, as we've gone through this COVID period, we've learned from home more, we've worked from home more, we've played from home more in terms of gaming, and all of this has placed demand on personal electronics and therefore semiconductor chips. Second to that, we've seen a big speed up in digital transformation, in online spending, e-commerce, and all of this has driven demand for data centers, again, very supportive of the semiconductor chip market. And as we've seen more recently, is that we've seen a big pickup in the smartphone, in the smartphone industry, really being driven by pent-up demand, and of course, 5G now coming into the market in quite a big way. So we don't know when these shortages will be rectified. I mean, a lot of companies are saying towards the end of the year, possibly into 2022. We know more capacity is coming online, but why do we like this sector longer term? Really, the reason is because all of these secular trends that I'm talking about now, all of these things that have been supporting the market will continue. Okay, so we see 5G really, it's just in its infancy at the moment. I mean, it will continue to grow for a while. We believe that there'll be a lot more growth in terms of data centers as digital transformation continues, and of course also as people shop more online. And then, you know, not to mention artificial intelligence, the Internet of Things, electric vehicles or autonomous vehicles, all of these new technologies are going to require more and more semiconductor chips. So we believe that there's a very strong demand for this part of the market, and it's very, very well supported. How have we decided to play this market? Well, we've basically done it through Samsung Electronics. The Samsung Electronics has the highest market share in terms of semiconductor memory. It also has a foundry part of its business, and within that foundry part of its business, it manufactures leading-edge technology for third parties. And then we also own NXP Semiconductors, which more plays on the automotive part, on the auto semiconductor chip part of the market. So just moving on, the last topic I really wanted to chat about is electrification. So this is a theme we really like in terms of playing the energy transition. So, you know, as we know, we are trying to move away as a globe. We're trying to move away from fossil fuels and more towards low carbon sources of energy. Electricity is attractive in this way because you can generate electricity through renewable sources of energy. So it's relatively cleaner than your fossil fuels. So over the next 20 years, we expect it's expected that energy consumption will grow around 22%, but within that, it's expected that electricity consumption will grow 86%. So really, electricity is becoming a bigger and a bigger component of our overall energy mix because it has greener qualities than fossil fuel. So what does this really mean? Well, we find this a very attractive trend for electrical companies. So what we, and why is it attractive? Well, first of all, because we are going to have to modernize, we're going to have to update, we're going to have to extend our current electrical grids globally. Second to that, the way renewable energy is attached to a grid, to the electrical grid, is very decentralized. So all of those increased connections will be very good for electrical companies. We're going to see more electronic vehicles on the road, again, with more electrical content than before. And then we'll have electric vehicle charging stations. I mean, so not only the individual charging stations, but also the fact that a lot of commercial buildings will, of course, not set up initially to handle the load of charging, let's say, 10 electric vehicles at one point, which means we're going to see those commercial buildings being retrofitted in terms of being able to handle the capacity of being able to charge those cars. And then, of course, data centers. We've talked about the growth in data centers. This has obviously been very, this is a trend that we've been talking about that will be supportive of electrification because they generally are very highly energy intensive and they use a lot of electric content. Yeah, so basically all of these are just very attractive trends that are supporting the sector. How have we decided to play it? We've decided to play it through a company called Eaton Corporation, which has about 30%. It's a global company. It's a global power management company. It has about a 30% market share in the United States. And really what we like about that is we've seen Biden come out with his $2 trillion fiscal package, which will be very supportive of updating the US grid, but also really there will be a strong angle which is towards the energy transition. Interestingly enough, now we're just talking about some of the semiconductor companies adding capacity. So TSMC and Intel are both building manufacturing plants within the US, and these again are very, they have a lot of electrical content, and this sort of onshoring into the US will definitely benefit companies such as Eaton. And then, lastly, just another company that also plays into this that we've bought is a company called Rexel, which is an electrical distribution company that will also benefit from this increase in electrification that we will be seeing globally. Okay, so I think I'm going to end it off there, and I'm going to hand over to my colleague, Dr. James Cook, just to go through how we're thinking about equity markets and our active equity approach. Thanks very much.
Thanks, Kathy. So, what is driving equity markets currently? Global equity markets have four big drivers: money supply, economic growth, sentiment, and valuation. Now, by far the biggest driver recently has been global money supply. Efforts to support economies from central banks and governments have created an environment that has generated huge asset price inflation. So I think you generally know interest rates are at millennial lows, central bank asset purchases have been gigantic, and fiscal policy, so that's government spending, has also been hugely supportive. So this next slide, we're going to look at the amount of central bank asset purchases. And you might remember this was what was known as unconventional policy back in the global financial crisis. Here we can see on the green line the combined balance sheets of the US central bank, the European central bank, Japanese, and the Bank of England central bank. So the four major central banks in the world. And you can see that that balance sheet increased what now looks like slightly during the global financial crisis, and then the huge increase that we've seen during the global pandemic. And then you can also see in the red line the level of the global index, FTSE All World Index, and you can see they do look like they're well linked. Now, when we look forwards, we know that the pace of central bank balance sheet purchases is going to be reduced. But we are going to continue to see central balance sheet expansion. Now, the key worry for a lot of market participants is what is going to happen to inflation, because we've been anticipating high levels of inflation for a little while, especially because we've been seeing that come through on our high frequency data. And we believe that this is going to be transitory, so inflation is going to decrease, so we're going to have disinflation for a while. Stubbornly high inflation, though, would force the central banks to have to raise interest rates, and that would cause a disorderly market. So to be really clear, that is not our central case at the moment, but it is obviously something that we're very aware of and watch very closely, and is a big risk to financial markets. I mentioned fiscal policy already. That's been very supportive too. So President Joe Biden unveiled a $2 trillion stimulus plan earlier this year. And for context, that's close to 10% of US GDP. And all the measures that have been taken to support households and businesses during the pandemic have led to increased levels of household savings generally. Remember, people haven't been able to go out and buy goods and services. And actually, the level of excess household savings in the US, again, is about $2 trillion. And it's a similar story throughout much of the rest of the world. Now, growth in money supply has had a much bigger impact on equity returns than economic growth. Here we can see the aggregate earnings of the FTSE All Country World Index for different years and how those estimates have changed over time. So for instance, you can see that during the global financial crisis, you saw a huge deterioration in expected earnings growth, and you saw a similar story, very similar story during the global pandemic. And then interestingly, when you look forwards, you do see that markets are expecting to see recoveries in earnings growth. If you look at the very end of each of these coloured lines, you can see that from the period between 2011 and 2016, there was actually very little aggregate earnings growth. And yet we saw markets go up by over 50%, the global equity market go up by over 50%. Now, this was reflective of relatively low valuations at that point, but really it was hugely due to this huge growth in global money supply. Now, when we look at how the world is going to recover from the pandemic, it's going to be an asynchronous recovery. The world isn't recovering all at the same place, and that's due to a huge degree to how vaccine rollout programs are going. And the two areas of the world that are interesting from that perspective are the United States and the United Kingdom, where we've seen positive revisions to GDP expectations because the vaccine rollouts have been going well so far. So clearly, flies in the ointment could be the rise of the Indian variant. However, recent data from Public Health England has suggested that the vaccines do seem to be effective against that too. Now, I think the other areas to talk about are valuation. So we know that markets are now reaching some all-time highs, and it is worth remembering that typically some of the best returns actually come towards the end of bull markets, which makes it quite difficult for investors to time entry to markets. And sentiment, we've mentioned, of course, so sentiment is also hugely impacted by what's going on with COVID. Really, there's two elements to sentiment, both greed and fear. And it's worth remembering all these people sitting at home with their excess savings have wanted to do something. And we have seen a big increase in retail participation in the market. And there are areas of the market that we have been highlighting for some time that have been very frothy, such as technology companies that have never actually made money or generated positive cash flow. And we generally seek to avoid those. So I'm already diving into the bottom-up aspects of things. To a large degree, we've explained some of the major top-down factors that influence global equity markets. And now I'm going to talk through what our active global equity team looks at from a bottom-up perspective. So our key philosophy is to look at quality companies that offer growth at a reasonable price. I think growth at a reasonable price is fairly well understood by people. We're looking for companies that are growing their intrinsic value over time, and we're looking to not overpay for those. But quality, I think, requires a little bit more explanation, and let's talk through all the different aspects of that. So we look for companies that have strong balance sheets, and the reason for that is during times of difficulty, the cost of capital is known, so they're not forced out to go and raise money at times when it could be hugely expensive. But also having strong balance sheets provides a lot of optionality for doing M&A activity. Then we like to see companies that are growing intrinsic value. Now there's lots of different ways to say this. We could look at generating returns ahead of their cost of capital. And we like to find companies that are actually delivering a lot of that in cash, so they have relatively high cash conversions. And then we go on to shareholder treatment. So really, this is the governance aspect of ESG. We like to see companies and management teams that have treated investors well over time, treated shareholders well over time. And the environmental and social aspects are really embedded into our process within looking at the sustainability of business models. Why are companies able to deliver ahead of their cost of capital for a prolonged period of time? And what are the barriers to entry and what are the risks involved? And then we're looking for steady and growing earnings. So we build our bottom-up models of companies basing our assumptions on the key value drivers that we see from companies, and generally are basing our valuations on discounted free cash flow metrics. And it's really important to, we think, focus on quality, because over time, all of these elements that we look at have been shown to provide good levels of returns. And helping to avoid stocks that lose money, remember that over any given 5-year period, typically 40% of equities actually go down. So seeking to avoid those, we think, helps to set up for success, and while trying to identify some of the big winners that make big superior returns. So how have we actually been doing? So here we're looking at the Global Leaders Fund. So this invests in up to 25 global mega capitalization companies that fit these quality criteria and growth at a reasonable price criteria we've talked about. Now, the style over the last year has actually not been very much in favor. Over the last year, you would have been better to invest in small companies that have fairly lousy levels of profitability and are also pretty volatile. However, when we look forwards, those don't tend to be the things that work particularly well in the longer term. And when we look over a 3-year period, actually, even though we're slightly disappointed with the performance over the last year, on a 3-year basis, the Global Leaders strategy has delivered returns that are pretty much in line with the global market, with considerably less risk and ahead of the global large cap blend peer groups. That's the Morningstar blend peer group. So you can see these charts on the bottom right. They're showing reward on the vertical axis and an objective measure of risk, a crude measure of risk, standard deviation on the abscissa. And you can see what you really ideally would want to do is to find that your strategy is in the top left quadrant. That would be delivering returns superior to that of the comparator, but with lower levels of risk. And you really seek to avoid those strategies, I would imagine, that are in the bottom right quadrant. So we've taken less risk than the market and delivered very slightly less return over a 3-year period, and over a 5-year period, again, delivered with taking less risk than the peer group and slightly better returns than the peer group has. We also have a global equity growth strategy, which the firm is keen to launch as a fund, is intending to launch as a fund. And you can see here that we've delivered returns that are superior to the market and the global large cap growth peer group, a slightly different Morningstar peer group here. And that's really pleasing to manage to pick a lot of the winners and thankfully avoid the losers there. So two really quite different styles that can be used in a whole variety of different ways. So thank you very much. I'll just tick up the required disclaimer and thank you for your time. So after the break, I'd like to welcome Chris Siriam, Head of LDI and Structuring, and Navin Lala, Client Solution Manager, onto the stage, and they're going to share their views on managing longevity risk. Thank you.